Hello and welcome to Edison TV. I'm Dan Ridsdale, and today I'm joined by Ben Wilkinson, Chief Executive Officer of Molten Ventures. Molten Ventures are a London-based VC, one of Europe's largest VCs focused on the European technology sector. Ben, many thanks for joining me today.
Thank you for having me on.
And to start with, you've had a successful 2024, a number of successful exits, releasing about 124 million of capital. Can you just discuss those exits that you achieved over the course of the year?
Yeah, as I think everybody recognizes, providing liquidity into our evergreen balance sheet is an important feature, and with these realizations, but also crucially selling our assets above our holding value and proving the fair value that we have them in the books. And so that cadence of activity is over the years that we've been listed, been an important feature for us. And in aggregate, we've delivered 600 million back to our balance sheet. And last year, we started the year giving some guidance to say we were targeting 100 million to come through. And then with four main transactions, as you say, we've delivered up to the interim period and just beyond 124 million coming back. First one was Perkbox, which have been in our portfolio since 2016, 2017. Then we continued to support the business as it scaled. We sold that and announced it in the sort of early part of our financial year, so in the April-May period of 24. And that delivered a multiple on invested capital of about 1.3x, but crucially above, again, the holding value. And when we talk about these exits, it's important to put them into context of the range of venture capital returns. And so when we have Graphcore as an example, which was an asset that's been in the portfolio for several years, had a good run up in terms of valuation, and then ultimately didn't quite deliver on the market potential that we were seeing for a variety of reasons. And that's the nature of technology investing. Ultimately, you're placing investments for future opportunity, and sometimes they come to fruition and sometimes not. In the case of Graphcore, we got slightly less than our money back out, but again, at the holding value, we had it in the books. And then with Endomag, there was a subsequent sale from a medical device company that had been in the portfolio for a similar amount of time, since around 2017. And that delivered just under a 4x multiple for us in the period. And also crucially returned capital not just to our public balance sheet, but to our EIS and VCT shareholders, which proved the value of those co-investment pools of capital. So we had about 36 million coming back from that transaction. And then the larger one was M-Files. That had been in the portfolio for a longer period of time. This was a intelligent document management company, and that had been in since 2013. We continued to back and invest in the company and support them on that journey. And the exit there was a private equity recap as they go to that next stage of their growth, and that delivered back to us a 7x multiple and almost 50 million of capital. And so there's a nice spread within those four, and I think actually the cadence of them and the kind of regular news flow that's generated has been important in the year, as well as being able to recycle that capital into our capital allocation policy.
Yeah, and just looking at that capital recycling, I understand that part of your proceeds will be reinvested into new opportunities, with secondaries being, a particular focus, really to, I guess, position yourself for the next VC cycle. Can you tell us more about that?
Yeah, I see the market really has sort of a tension that exists at the moment, as we see the public markets have been struggling for liquidity, and share prices have therefore been trading below asset values. There's a tension naturally, therefore, to support the share price. That's what we're here for, to provide returns to our shareholders, but also to build fundamental value into the business. And we're in the unique position where we're supporting innovation and productivity that the public market shareholders can't really get access to unless they own shares through Molten Ventures. And our ability, therefore, to drive future vintages. Venture capital is a long-term asset class, and so investing into new technologies and being consistent about that creation of new investments and supporting those technology shifts as they come, that creates the value that will be accruing in 3-4+ years time. And so we're very keen on making sure that we stay in the market, we stay active, particularly now where I think we're in the midst of a generational technology shift. This is a very unique opportunity, even if you look over a 50 to 100-year timescale. I think we're in the midst of a value creation shift that I don't want our shareholders to miss out on. And so to make sure we continue to invest is important. But as you described there, secondaries in a market where there's a pricing arbitrage is a great way to create value. And we've have a strong track record of investing in assets and also funds where there are clear leading companies in those portfolios. I'm thinking around the transactions we've done with Seedcamp and with Earlybird, and then in the last year with Connect Ventures as well. And that's given us an exposure to TransferWise, to UiPath, to most recently Typeform and Soldo, and also to Revolut. And that just adds additional value to our shareholders. And the beauty of secondaries is that you can price known assets and known winners. And because of the liquidity arbitrage, you could often price them at a discount to their true value. And then you get the benefit of, because they're more mature, being able to recycle those companies into cash in a shorter time frame than you would do with just pure primary investing. And so I think with Molten, you have that unique capability of having that blend of primary and secondary investing opportunity to create value, and that is distinct. If you look at our capital allocation policy, we point to those opportunities, but we also point to the need to support the share price. And so we're saying 10% of our realizations will go into buybacks, and we put that program in place in the summer. And as we get more liquidity coming through from subsequent sales, we'll continue to follow that policy.
Right, and in terms of the current valuation environment for VC-backed companies, you've seen stable portfolio valuations, relatively few fair value movements, and exits have been done at somewhat above the carrying value. Yeah, can you discuss the valuation environment that you're seeing at the moment?
Yeah, I think there's always two parts. One is valuation for new deals, and I think the venture ecosystem in Europe, which is where we look to invest in new companies, is being a little bifurcated between kind of AI-driven or perceived winners taking quite significant multiples on valuations, and then perhaps some of the other companies struggling a little more to raise capital. Through 24, we probably saw that picture improving. We saw more VC funds raising new capital sources, and I think into 25 we'll see that unwinding somewhat. VC is, because of its long-term nature, is very much correlated to interest rates as well. So we see kind of macro swings playing a significant factor in the perception of interest rates, but then feeds through to the perception of valuation multiples. So I think that will continue, although we're probably fair to say that the last couple of years we've been through the worst of that. From our own portfolio perspective, we follow the IPEV guidelines, and we're very sensible about how we mark our assets. We're slow to move them up in terms of increasing value, and we're ensuring that we move them down in advance when we're starting to see that the companies may not be hitting some of their proof points that we'd want to see. And over the 8 years that we've been listed, that's proven to be the right way to approach our valuations. And we've had then the cadence of realizations that really give the litmus test to investors to show that we've been holding them at the right levels. And so I'm happy with the way that we've moved the assets up, and I'm happy with the way that we've subsequently moved them down if they haven't hit their targets. And I think we've been able to demonstrate to investors that we've been very sensible about those marks.
Yeah, and then looking at your core holdings, can you give us a bit of detail in terms of the expected revenue momentum of those holdings and also the cash runway for them?
Yeah, we aggregate what we call our core, which is between 50 and 20 assets in any period, and it represents more than 60% of the portfolio value. So these are the companies that we, if you like, put in the shop window to our shareholders to see what drives those expected NAV returns and shows the kind of more mature businesses in the portfolio. They're growing at the moment of an average of 50% into the coming year. And that's showing, therefore, strong growth, which is clearly important. And for the stage in the market that we invest in, you've got a blend of mature businesses which will have lower levels of growth and some which will be growing above that, but the average being 50%. Their cash runway is positive in the sense of we've got more than 75% with more than 12 months of cash runway. It's very normal in venture capital that the companies would raise for a 12 to 18 month window. And so we'll always have some companies in the market. And we've been able to prove over the years and including in the last year that our companies are able to raise additional capital, not just from us, but from a syndicate of investors. And as they mature and grow, it tends to be that we will stay with those companies, but we won't be the majority source of capital. And those proof points are equally as important as when we look to realize. And so again, the news flow we've had within the portfolio has been very positive on that.
Just giving your thoughts on the overall European VC market. We're seeing, I guess, continued de-equitization of the listed tech sector. Can you talk about the European VC market as a means to get exposure to innovative technology businesses?
I'm super positive about the future for Europe and venture capital, and I think there's a few factors that play into that. One is that we've seen Europe as an ecosystem for venture maturing. When we listed in 2016, we're about 20 billion of scale in terms of the market in Europe. That's probably around 80 billion now, so it's shown a natural progression. We had a peak period a few years ago where it went over 100 billion. And the reason that capital is available in Europe and coming into that ecosystem is because we have really strong underlying IP coming out of universities, but also entrepreneurs creating companies. And so there are certain sectors where Europe has been particularly strong globally, but it's always had, over the past 20, 30 years, strong IP coming through. What's perhaps been lacking is that scale of capital at all the stages of a company's life cycle. So from early stage through to growth where we play, and then to later stage growth and IPO. What's important is to have that consistency. And at the moment, there is a gap to capital that persists at the stage where we are in that Series B early growth stage. And I think, therefore, it's important that we see more capital being unlocked. And I'm positive to see that the discussions around pension reforms and such like are having an impact in terms of at least momentum and perception, but gives us a sense that the capital will start to come. What is true, though, is that we're still a third the size of the US, and so we're under scale. I'm talking about a story where we've matured and improved, and I see Europe institutionalizing in terms of its venture capital as an asset class, but there's a long way to go, and I do think it's important that governments continue to recognize the need to support that ecosystem, and unlocking pension capital is an important part of that. But it isn't just an altruistic unlocking pension capital for the sake of supporting our ecosystem. This is about returns, and venture has proven that it can generate strong returns higher than public markets, even after costs. And it's diversified in terms of the asset class relative to other asset classes and how it performs. And therefore, it should be part of a diversified portfolio. And I think ultimately, Molten can be seen as a portfolio approach where you buy shares in Molten because you're thinking about it in the round of an entire portfolio, and we're giving access to an asset class with daily liquidity. So for me, we'll have done our job well when we'll have generalist fund managers not necessarily needing to understand every underlying company, but just understanding that this is institutional and that they can buy a share in Molten to get access to the VC space.
Yeah, interesting. And you mentioned the pension reforms, the managed accounts reforms, and we've recently seen the government announce its AI initiatives and embracing AI, I guess, more overtly. Can you just give your views in terms of the role government has to play in supporting the tech sector and how that relates to your business?
Yeah, I'm actually of the view that we've probably not been active enough in supporting technology sector, even capital markets. I think we've been slow from a government perspective to respond to that. So I really welcome that active response. I think we all will probably agree that it's not always perfect when governments become involved, but there's always a requirement. We'd like to believe in perfect markets, and even if you have a capitalist bent, we always understand that there's pricing anomalies and disconnects that occur in markets, and some of that's from timing. But direction of government, I believe, is important. Making sure we can capitalize on what we generate here from the perspective of the IP, like the AI technologies that we have, like the energy space technologies that we have, that the life science technologies. We do have a lot to celebrate, and I think if governments can help business and investors to support those ecosystems better, that's what we should be doing. And I think we sometimes fall into a trap of assuming that everybody else in the world is not doing this, which isn't the case. You can see in the US that there's a lot of active intervention to support their ecosystem and their businesses, and that's generating a lot of growth. And that's also allowing US players to acquire IP from Europe. And I think if we can support our IP better with some state intervention at the right levels in the right places, then clearly that's, to my mind, welcome.
Yeah, no, very interesting. And then, we talked on this a little bit before, but given the de-equitization of the UK, of the European technology sector, really, what are the implications of that on your business? Are you having to carry more weight in terms of scale up and scaling your businesses for longer? And also in terms of your entry points, are you looking at later stage businesses because of that? Can you discuss that dynamic?
I think our unique skill set has played out in the Series A and Series B investing part of the market, and I don't see that changing. What has changed in terms of that de-equitization is that the public markets have had substantially less liquidity to support the ecosystem, and that's obviously affecting share prices versus asset values. And that, in response to that, we therefore have to be very obviously clear on our messages. We have to be very clear on our ability to generate returns and value. But it also means that we look to drive liquidity and additional buyers coming into the shares, with trying to generate interest out of broader Europe and broader US. I think the reality is that the role of what we do has become probably more important to support an ecosystem where previously you would have had the AIM market playing a role for companies as part of their growth journey that doesn't really exist today in the same way. And therefore companies staying private for longer is a continued feature. And as such, the role of Molten Ventures to ensure that we can be consistent in delivering capital and ensuring that we can stay with our best companies through that journey is crucial. And so the way I look at that is that we need to have increased scale over time. We could comfortably be 2-3 times our size. Some of that will maybe through realizations and driving returns from the existing balance sheet, but some of that will be from raising third-party capital, be that possibly from pension funds or other institutional players that recognize the value of this ecosystem. And so I think the scale point has become more relevant over the last even 2-3 years, probably.
Yeah, interesting. It increased scale, but it also increased importance given the need to scale up all of our technology businesses. Ben, many thanks for joining me today. Fantastic conversation, and look forward to seeing you again soon.
Appreciate the time as always. Thank you, Dan.